The markets, stock markets in particular, saw a major rebound this week on the back of lower inflation data. But our next guest says don't celebrate too early. He's predicting a series of macroeconomic variables that are going to be even worse than today, including higher unemployment and perhaps even worse recessionary outcomes from a lot of different factors that we're looking at today with Alfonso Peccatiello. He is the author of The Macro Compass, and we'll be talking about how he's expanding his service. Very exciting, Alfonso. You're expanding your newsletter to a full-fledged macro service. Congratulations. We'll talk about that. Welcome back to the show.
Thanks, David. It's always a pleasure to be interviewed by you here at Kitco.
Always a pleasure to have you, Alfonso. We're going to be talking about a lot of things. I know we're both smiling because we're happy to be talking to each other and amidst this terrible economic environment. But let's try to pull out some good news towards the end for the viewers here, because I know you got some bad news and it's important to talk about that, but maybe there's some light at the end of the tunnel. Let's talk about inflation first. Inflation is very important. 7.7% was the headline inflation CPI coming out of the U.S. this week. Now 6.3% was the core inflation, slightly lower, both numbers slightly lower than the previous month. Importantly, core inflation was trending up all throughout the summer, finally came down a little bit. Headline inflation came down quite a bit compared to the previous month. The stock markets, the S&P 500 went up 4% in one day. So basically wiped out all of last week's losses. And then gained some. So significant gains on this data. Let's talk about inflation. I made an analogy offline. You know, these memes of the athletes, the runners, they're running towards the finish line and they've got 10 meters left. The guy at the front is almost there and he's celebrating before he gets to the finish line because he thinks he's going to win. And then while he's slowing down, somebody else pulls up ahead of him and beats him. I just want to make sure, Alfonso, that the market is not the guy celebrating too early.
Yeah, so let's talk about inflation for a second, David. Yeah. So the print there was a good one. The direction is good. Inflation showed the first preliminary signs of slowing down. The Fed is very focused on core inflation, month-on-month prints of core inflation. And this print was 0.27%. That's the weakest since summer 2021, not 2022. So it was a relatively weaker print, and markets just went ballistic. Now, if you look at the trending rate of this inflation, you smooth it maybe on a 3-month basis, rather than just look at 1 month, David, you're still looking at 0.5% month over month on a trending basis. So, you're going down, probably you've reached the peak in core inflation, but the markets are celebrating like, it's all coming down to 2% very quick. Now, Powell has been very clear. His hero is Volcker. And Volcker did the very same mistake of these meme athletes that you're talking about. Volcker celebrated before hitting the finish line for the first time in the earliest part of the 1970s, where he thought he had won the inflation battle. Mm-hmm. So he loosened his belt. He eased up basically his monetary policy too early, and inflation came back and surpassed him on the finish line actually, and went there and won the initial battle. And inflation just went up even faster in the second half of the 1970s, which forced Volcker to do not only what he was doing before, so hike rates, but hike them much, much more, much, much faster to make sure he finally won his battle. Now, Volcker wrote a book about this. The book is called Keeping at It. How many times have you heard Powell in his press conference say, "We will keep at it until the job is done"? He's using the very same words that Volcker used in his book when assessing the very single mistake Volcker himself did, which is to slow down too early. So one print in inflation, which is 0.27%, David, is not going to change radically Powell's stance. He wants to make sure he has completely defeated inflation before easing monetary policy again. And the markets are behaving like, he already won the battle, but the reality is that he hasn't won the battle yet.
Mm-hmm. I want to come back to inflation, but it's interesting how you brought up the 80s, because I'm looking at data from the 80s. Yes, you're right. Volcker hiked up rates, caused a big recession in the late 70s, early 80s. It lasted 2-3 years, but the stock markets quickly rebounded after the recession officially ended. We saw a continuous bull rally until 1987. So perhaps I'm just speculating, this might be a good buying opportunity.
So between now and year end, David, we have another inflation print and a labor market report. Mm-hmm. If we get labor market data, which is not very, very strong, but just, a slow deceleration in the labor market activity, not yet a recessionary environment, and you get inflation trending down a bit more, Oh, David, people are going to chase this move up. They're going to buy more equities. They're going to buy more bonds. But you know who's going to do that the most? It's institutional investors. And why is that? I've been in their seat. I managed a $20 billion portfolio until last year. If you have had a good year as a trader, as an institutional investor, David, you were short everything this year, right? And then you had a good run. You were short equities, short Bitcoin, short everything. Comes November, October, November, it's almost bonus time. And bonus is paid as a percentage of your profit and loss in the industry. Now, if you have made so much money this year, you're looking at a good bonus ahead of you. What is your biggest risk between now and year end? That you're still short and the market has one of these face-ripping bear market rallies in front of you, and most of your bonus is wiped out all of a sudden. You don't want to run that risk, right? So what you're going to do is at the first sign of this bear market rally unfolding, you're going to buy more. You're going to buy call options on top of that because you don't want to run the risk that actually your performance gets depleted and watered down at the end of the year, and so does your bonus. So it's a very institutional driven mechanism and behavior that people have to preserve their own incentive scheme, but it is how it is. And if inflation slows down again in December, people will be buying the hell out of everything, bond market, a stock market, et cetera, et cetera. What it means for 2023, that's a different story. We can chat about that.
Okay. Let's come back to inflation, and then we'll move on to other asset classes. Now, inflation, you said, as you've pointed out, it's directionally on a good path. So it's coming back down. Directionally could be, it doesn't tell us the timeline, because if inflation is directionally coming down, it could be coming down by 0.1% every month from now on. That's still pretty bad. I don't want to live in an environment where we have 7% inflation forever, right? At what point can we see the Fed's target of 2%?
So I expect inflation to be at 2% by late 2023, beginning of 2024. Okay. That's pretty quick. We're at 7% now, right?
I want to make that note very clear, because some people I talked to said we will never see 2% ever again. Oh. I mean, you're saying it will take a while, but we will eventually get there.
Okay, David, we have to really talk about cycles and trends. Okay. Because what people are doing is they're taking the 2021 big fiscal impulse cycle that we had, an inflationary spike that we had, and they're extrapolating that this will last forever and that there will be no cycle in the meantime. And I think they're wrong, because inflation structurally might want to settle at a new regime, 3-4%, let's say. But that doesn't mean, David, that temporarily in 2024, you can't see inflation at 1% or at 0%. Cyclically, you can get there until you go back to your structural trends. And how do you get to inflation at 2% by the beginning of 2024 is the following. You get there with the recession. Yes. Every time in the last 100 years that the US had a recession and it entered this recession with inflation rate above the Fed target, it always exited the recession with inflation rate way below the Fed target. Actually, every recession in the US took inflation down, David, by 7 percentage points. That will bring inflation down from 8% to 1. And on average, it takes 16 months. 16 months from now puts us exactly in early 2024 with inflation in the 1 to 2% camp. Mm-hmm. That doesn't mean that later on inflation doesn't go back to its structural trends, but cycles can be very vicious on the way up and on the way down.
Yes, I think that's a very important distinction we have to make. You're absolutely right. We'll pull up this chart. In the past, I'm looking at the St. Louis Fed data all the way back to the 1960s. Every single recessionary period is followed or actually coincides with decreasing inflation, as you pointed out. So that's absolutely correct. People have been telling me about a stagflationary environment, but we have to differentiate. Stagflation doesn't mean a contraction necessarily in the economy. It just means we're not growing. A recession, by definition, means we're contracting. So at no point in the past 50 to 100 years in economic history have we had a contractionary period coupled by rising inflation. It's always decreasing inflation. So let's talk about stagflation versus a recession.
So stagflation is what we had in the first half of 2022. If you look at the real economic growth, actually GDP growth recorded was even negative in the US, right, for 2 quarters. And then it basically went up again in Q3. But if you look at other things like retail sales, and you look at the volume of these retail sales, David, they've been pretty flat in the US for 6 to 8 months, right? So people are spending more in nominal terms because prices are higher, but the volume of things they're buying hasn't gone up. Global trade has also flatlined. So growth was pretty much stagnant in the first half of the year. Inflation was not, as you pointed out, core inflation in summer was running very hot. That's a stagflationary environment. What's ahead of us, though, actually, it's a two-way street. Either we engineer a soft landing, and a soft landing here is interpreted as growth slows down, but just a tiny bit, acceptable levels, let's say, and inflation comes down very fast. That's the preferred outcome for the Fed. The other outcome is a recession. And a recession, yes, manages to slow down inflation by a mile, but also kills the labor market, kills purchasing power for people, kills earnings. That's like what happened in 2001. And the Fed cut interest rate in 2001 by 500 basis points in a year, from 6.5 to 1.5 in 15 months, David. That's a pivot. That's a very strong pivot. If I ask you, what did the stock market do in 2001? Or the dollar do? It went down. It went down because the Fed, yes, had pivoted. Of course it did, but because people were getting unemployed. Companies were delivering negative earnings. How can you buy stocks in that environment? As you correctly pointed out many times, the stock market tends to bottom before GDP bottoms. But if we're going into a recession, we're far away from GDP bottoming where we are today.
Okay, good. So I want to finish up on your macro outlook, and then I want to talk about these asset classes, stocks, real estate, Bitcoin, and gold in that order. I know you have predictions for all of them. Your Bitcoin call from last 2 months was actually spot on. You called for $16,000 was your target. We're almost there. We're at the high end of the 16,000. We'll come back to that. We'll give an update to your Bitcoin call. But first, let's finish up on your macro call. So like you said, stock markets tend to recover before the end of the recession. So the obvious question is, when and how will this recession end?
So, David, how it works is that so far we have seen flatlining growth. And then at some point, because the Fed has raised rates so rapidly and is at tightened conditions so quick, it actually goes into the labor market as well. It takes a little bit of a time, but it will get there. And I think you will see the evidence already coming in over the next few quarters that is happening. You know, when that happens, then people get unemployed, they spend less, and it's a negative cycle for earnings, et cetera, et cetera. These cycles generally last 9 to 12 months. So that means that if we start now, we should see basically the bottoming in earnings and sentiment roughly in the third quarter of next year. That's a way to go from where we are today, right? At that point, David, though, that's the point where you want to buy stuff. That's the point where you want to load up. Why? Because the most negative consequences have already been priced in. The negative earnings cycle, the recession is already priced in. The Fed at that point will have pivoted, but people don't want to buy stuff because they're losing their job. That's when you want to buy stuff because the Fed is going to support the economy. Inflation is likely coming down very fast, and the negative earnings cycle is already priced in. Today, none of these three conditions are yet to be realized. So we'll have to be a bit more patient, structurally speaking. Yes, we can have a bear market rally. Okay. Between 2000 and 2001, David, one last statistics is the NASDAQ rallied 20% or more 7 times between 2000 and 2001. Overall, though, it dropped from its peak in 1999 to 2002. So it took another year, full year for the NASDAQ to bottom, despite this 20% very frequent bear market rallies. We are in a very similar macro setup. In July, you invited me later on, I think it was August maybe, to an interview here. Everybody was talking about the new bull market. Do you remember that? In July, the NASDAQ rallied 20%. It was a new bull market. Bull market what? It's a bear market rally. Earnings have still to bottom. And your indication that the stock market bottom slightly ahead of GDP market bottom, it means we have to wait a bit more.
They weren't, I guess in retrospect, they weren't bull rallies. They were just rebounds, technical rebounds.
Correct.
You have a table here actually outlining the performance of asset classes in late 2000 and early 2001. I want to come back to that because you have a lot of these commodities and FX and rates and equities that performed surprisingly to me, actually. Gold went down 7%. Okay, so let's talk about first unemployment. Do you have a target for how high unemployment will reach before the recession ends?
Yeah, I think 6.5% is totally doable in the US. Mind you, we're at 3.5, 3.7 today. So that's 3 full percentage points in only 1 year until the end of 2023. Now, why do I think it's going to be that bad is mostly because of the housing market. Now, the housing market represents in the US 15 to 80%, together with these ancillary activities, construction workers, brokerages, et cetera, et cetera. It's 15 to 18% of GDP and roughly 12 to 15% of the workforce. What I'm saying is that in the US, there are roughly 12 million jobs related to the real estate market. And the real estate market, David, is completely frozen. And it's going to be much worse next year. Buyers cannot afford to come out. Sellers for now are not selling. At some point, they will be forced to sell back to the market when they start losing their job early next year. So what I say is new construction workers, new brokerages, they're not going to be there because this is not a good environment for creating jobs in the real estate market. They're going to be destroyed. 12 million jobs. If only 20%, 15 to 20% of these jobs, the jobs that were created in the hype of the 2021 real estate semi-bubble, if only 20% of the total jobs are cut, you're looking at 2.5 million jobs lost only in the real estate market next year in the US. Now, sum up a bit of weakness elsewhere, and you easily end up with an unemployment rate at 6.5%. Look at that chart I just put there. It shows the housing indicator in the US inverted. So when it goes up, it means the housing market is weakening, actually. And then it shows unemployment rate against it 12 months later. That indicator is telling us that unemployment rate by late 2023, beginning of 2024, will be 6.5%. That's much higher than what it is today.
Inverted, okay. But the housing index, so let's talk, so your this chart that shows a correlation and you've advanced the housing index by 12 months, so you're making it a more or less a leading indicator here. Yeah. What is the assumption here that the housing market, the assumption here is that the housing market will continue to fall, right? Let's talk about that assumption. What are you basing that on?
So, David, let's talk about where we are today. Okay. Housing sales are 70% down. Housing sales activity, so people putting their house for sale on the market, 70% less than last year in the US. And let me tell you why is that. To actually make a housing transaction, you need a buyer and a seller. Now, the buyer has been completely priced out of the market, 100%. So house prices are much higher on paper than they were a couple of years ago, and mortgage rates are at 7%, not at 3% anymore in the US. The combination of the two makes, basically the new buyer completely being priced out of the market. He can't afford it anymore. The median mortgage installment rate was $2,000 to buy the median house in the US. It's now $3,500. Where is he going to find the money? His wage didn't go up by 70%. So he's priced out. He doesn't have the power to buy the new house. So that means that the seller, if he wants to sell the house, in order to find a new buyer, he needs to lower his price, David. But he doesn't want to do that. As long as the labor market is strong, he's not going to sell his second house. He's not going to sell his Airbnb or his buy-to-let house. He's just going to keep it there, right? Now, that works, but it slows sales activity. Housing activity slows materially, and that's reflected in an indicator. Do you know when it worsens? It worsens when you start to lose your job or be, a bit more dubious about whether you will have a job in a couple of years from now, and you have a lot of equity that is sitting in that house. And maybe you say, okay, maybe I should take some of it away. Let me try and sell at least this apartment. And when you do, you still don't find a buyer at the price you want because he can't afford it, David. So the only thing you can do is you can lower your price. And we are seeing that already happening in the most frothy markets in the world when it comes to real estate. Canada, Australia, these prices on month-on-month basis are dropping at an annualized pace of 20% in some places in Canada and in Australia. Mm-hmm. And why? Because there it was the maximum excess. The US is not that far away. I expect housing prices in the US to drop 15% by the end of next year. People are not prepared for that. If it sounds scary, you only will get back to the same level that was there in early 2021. So it's not a disaster, but it's a negative impact on the consumer's balance sheet. And as housing prices drop, housing activity is terrible, you will have, loss in the job market. And that's, as you can see, very well predictable, looking at a leading indicator like the housing index and waiting for 12 months for its effect to unfold through the labor market.
Yeah, that's a good point. So labor market, but there's also an effect on discretionary spending. There's been multiple studies done on this that your home equity value, although it's just a paper value that you can't really tangibly touch, it's on your bank account. But when your house price falls, or your home price falls, your discretionary spending falls commensurately because you feel poor, and vice versa. I wonder if there's a percentage decrease or increase that matches the percentage or decrease fall of your home price. In other words, if your home price falls by 10, 50%, how much does your discretionary spending fall? I wonder if there's
Yeah, the studies you're pointing to normally point to a good correlation between the two, again, with a lag. So first house prices fall, and then you're like, oh my God, I mean, my neighbor tried to sell his house and he had to sell it for 20% less of what I think my house is worth. Let me look at my own balance sheet, and you're like, oops, I thought I had more equity into that. So you need to reassess that. It takes a while, and then you drop your discretionary consumer spending by roughly 1/10 of that. So 2% down. But 2% down in consumer spending is very large. Consumer spending is roughly 70% of US economic activity. So, and in Canada, it will be exactly the same. So do not underestimate the second round effect of a weaker housing market. Yes. It unfolds into a weaker labor market, into weaker consumer spending. And by the way, the Federal Reserve knows that. And actually, I'm going to go as far as to say that they want the housing market to slow down, exactly because of the effects we're talking about, David. It will slow down consumer spending. It will slow down the labor market. And ultimately, it will slow down inflation. It's a lot of pain, though, for people in the private sector. But hey, Powell told us, households will need to go through some unfortunate pain. Those are the consequences of having to face inflation. Yeah, maybe if we would have hiked a bit earlier, that would have helped. But since we are in this boat now, he needs to repair his own mistakes, and he will.
I do have to bring this up. We talked about this last time, the lesser of two evils. If the Fed has to choose between saving the economy or fighting inflation, they would, according to you, I think it's the lesser of two evils is fighting inflation, because in a recession, people lose jobs. I had some good comments in the video to respond to that comment that you made. People said, well, it depends on your perspective. If you're a retiree with lots of savings, you're not working anyway, you would rather have inflation come down. The slowing job market doesn't affect you. Or if you're
David, and sorry to interrupt you, but think about this. So Powell wants to go down as the guy who's laid the inflation dragon. And, he's not going to lose his job. He's going to make Americans lose their job in order for him to achieve his objective. It's part of his mandate. His incentive scheme is to succeed in slowing down inflation. He won't be fired. He won't be the one losing his job. So also from an incentive scheme perspective, obviously, he wants to slow inflation down much more than he wants other people.
I'm just going to push back slightly, because unemployment is their second mandate. If he pushes this too far, unemployment goes to 20%, he might actually lose his job.
Well, by the time unemployment goes to 20%, his term is over. You're making a good point. You're making a good point, David, because ultimately it's a trade-off. But right now, unemployment rate is 3.7, inflation is 8. So for him, right now, the trade-off doesn't exist.
Fair enough. All right. I'm wondering why you think the Canadian and UK real estate markets are more in danger than the US.
Okay, think about this. We talked about the US and people being forced to sell because they are, about to lose their job, or they're rethinking their own personal finances, right? Where you go into a recession. In the UK and Canada, you not only will have that, but because of the nature of the mortgage market, you will have additional problems. And let me try to explain what I mean. In Canada, almost all mortgages are actually a variable rate mortgage, which means that effectively you, as rates go up and Bank of Canada raises rates, you are kind of paying more month by month on your mortgage installment basis. Not all the market is like that, but the share of variable rate mortgages in Canada is pretty large, which means that you don't have to wait, David, all the way through the labor market to weaken and you to feel the pain for them to decide to sell your house. If the Bank of Canada keeps raising rates to fight inflation, you will feel it much earlier in your mortgage installment rate, in your mortgage payment. In the UK, the story is not about variable mortgage rates, but it's about the tenor of these mortgages. 50% of the market in the UK is less than 5-year mortgage rates, which means that all the mortgages that have been done in 2017, they looked awesome. 2% mortgage rate, very cheap, amazing. They all come due for refinancing now. And do you know what's the prevailing mortgage rate now in the UK? It's 6.5%, which means that friends I have in the UK, but this is mathematics, they're looking at a refinancing rate that will bring their mortgage monthly installment rate from 2,000 sterling to 4,000 sterling, 5,000 sterling immediately. So they don't have to wait for the labor market to weaken and reassess their finances. Both in Canada and in the UK, by the structure of the mortgage market, the pain will be felt earlier, which I think is one of the reasons why people might want to be forced actually to sell and reconsider their housing investments earlier than in the US.
Yeah, it's difficult because back during the pandemic, a lot of people, including myself, were thinking, oh, everything's gone up. Now is a good time to sell. But then I think to myself, if I sell my home, where am I going to live? Right? The housing market is not something like, okay, well, yeah, things went up. It's time to trade in your Bitcoins with cash. I can't just sell it. Where am I going to be homeless? What?
David, look, my mentor always said this. He made me laugh so much. So let me share it with the audience on Kitco.
Yeah.
Alpha, the housing market, you have three options. Either you are renting and then you're short the housing market. You don't own the house actively. You are choosing to rent. Okay. If you own a house, one house, you are not long the real estate market. Don't pretend to be a smart investor. You are living somewhere. You need to live somewhere. You just bought a roof for your head. If you have two houses, yeah, then the second house, yes, you're long the real estate market. But don't play Warren Buffett if you buy a house and you own it. It's you have to live somewhere. So you can't sell it that easily because you need a place to live, right? It's exactly your situation.
I've read also, and I'll finish up on real estate here. I've read also that perhaps a lot of people, large investors have a lot of cash on the sidelines and they're waiting for the markets, real estate markets in particular, to go down just a little bit more. And then they're all going to start piling in. So there's going to be this cushion of cash that's going to go in and stabilize things. We're not going to get a full crash. That's just what I've read, what I've heard. What do you think?
Well, what I think is that this is easy to say when the central bank has been there to basically back the markets for 10 years. At every dip, you feel it's an amazing opportunity immediately to step in and buy. This time is a bit different for one main reason. If you buy a T-bill in the US, a 6-month government-issued instrument, very liquid, it's just short-term money, basically, David, you get 4.5% yield. 4.5% yield is pretty decent risk-free return for 6 months compared to locking your money into a house and all the costs associated with it, by the way. So this time there's an opportunity instrument, which is government bonds, the short term, because rates have been raised so much, they offer a pretty decent outlet to park your cash. You don't need to buy a house because there is no alternative. The TINA is over because government bonds are yielding 3, 4, 5%. Even the short-dated ones. So I'm not sure that people during a recession will be so keen to say, instead of 5% on a government bond, let me actually, pick this falling knife here of housing prices falling 10% in a year. Let me try and buy them. I'm not so sure about that.
Okay. I want to go back to this table here of the different assets that perform well. You didn't have, well, obviously Bitcoin is not on this table because it was 2001. But let's talk about Bitcoin first. I'm going to come back to this table. Bitcoin, $16,000 was your last call. Amazing. We're almost there. Let me rephrase. It's not amazing that it's fallen to $16,000. Your call was amazing. But yes, what's your next target and why?
12K. Every time you interview me, David, I'm going to go for a lower target. No, I'm joking. It's not because I enjoy it, but it's because of the macro conditions.
Okay.
I think 12K is doable for the following reasons. The FTX debacle is pretty important, David, because if there was a hope that institutional investors would, welcome the new asset class over time, now you make the second largest exchange go belly up. I'm sorry, but I've been an institutional investor myself. Most of these dinosaurs taking decisions above me, they don't like the smell of risk, of something they don't understand particularly. So this is going to be basically taking away a potential source of new inflows, which is institutional money, for a very long time. And the second reason is that, again, if people are losing their job and things are getting worse in the economy next year, Bitcoin is actually the last thing they will want to buy. They will want to make sure they own liquid cash to meet their expenses. It's, again, for every asset, there is a cycle. And for Bitcoin, the stock market, this is not the cycle to be long. We need to be patient. At some point in 2023, later in 2023, there will be a 12K, 10K opportunity, which will look long-term extremely good. But we need to be patient. There are cycles. There is a time to go long, a time to go short, and a time to go fishing, as my mentor used to say. Now it's the time to be patient, go fishing, to not feel overwhelmed by having to buy the dip every time.
I have an explanation as to why people buy the dip. I think psychologically it hurts more to miss out on gains than to actually lose money.
This is such a good theory. Actually, it's scientifically proven. There have been experiments run on traders, gamblers, etc. Missing out on gains when you think you had a good idea, that hurts much more, and it's shown in behavior, and people want to chase that, and they'll be like, I lost the first 5%, and now I need to go and chase the next 10% move up. And also it has been fed by central bank puts, basically being always available over the last 10 years. The last 10 years, if there was a dip and you blinked, you missed it. And then you could never look back. It only went up after that. So I think that's also rooted in people's brain. But this is not like the last 10 years. It's materially different.
Okay. All right. Gold. Let's talk about gold now. You have this table here that showed that in 2000, from August to December 2000, gold went down by almost 1%. Between August 2000 and March 2001, so extending that period, it's down by 7%. You would think that gold would hedge against equity volatility, but that wasn't the case during the tech bubble.
Yeah, it's a very good observation. And that's the reason why I put gold in that table as well. Please notice that between December 2000 and March 2001, so the extension of this initial period you discussed, David, the Fed cut rates by 150 basis points, and yet gold fell by 7%. What? So that works according to the following idea. Equity markets are volatile. The Fed was cutting rates. That should be perfect for gold. Well, the problem was that the Fed was cutting rates because the economy was slowing down so hard, and the dollar at the same time was appreciating because people were so leveraged, they needed to deleverage in the global economy. And when they deleverage, they get their hands on the dollar. They want to bid the dollar higher in a deleveraging process, David. And don't forget, gold is denominated in dollars. When we talk about gold and we measure gold, we're looking at gold against the dollar. Sure. So if the economy is coming down very hard, people generally tend to reach for the dollar. They are leveraged in this dollar, so they want to make sure they have some dollars at end to pay their dollar liability. That's actually positive for the dollar and negative for gold in the first instance. If you look a bit beyond that, though, at the end of 2001, there was a very good bottom for gold because this deleveraging, this economic slowdown, as you said already before, was fully priced in. And when that is fully priced in, that is the moment to load up on assets. Since you invited me here, I think it was the beginning of 2022, I've always predicated patience. I mean, people, to me, it feels like there is a bunch of people out there that are itching. They're itching at every time and say, I need to buy this. This is a secular bottom. This is the way to get in. Now it's the time. I just predicate patience because macro cycles can take 12 to 24 months to unfold. We are just in the middle of this negative macro cycle. We should be patient. There is another leg coming. It's not a valuation leg this time. Yeah. It's a real economy drawdown leg. And you don't want to buy asset in that leg. You need to be a bit patient still.
Well, especially for the younger investors and traders out there, people my age, in 2008, I was still in high school, my last year of high school. I didn't have any money to invest, so obviously I missed that. It wasn't really a miss because I didn't have money, so forget that, right? And then afterward in 2020, personally, I missed that bottom too. So people looking at this are thinking, okay, I missed 2 secular bear markets. Those are fantastic once-in-a-lifetime buying opportunities. I can't miss this now, right? Yeah. So they're all waiting and ready to get back in. And the question that we've been discussing is when? What indicators do we look at to know that this is the right time to get right back in? Let's finish up on there and we'll talk about the macro compass.
So, David, the indicators to look at are the following. The moment historically when stock market bottoms is when earnings have already taken a major beating, unemployment rate has gone up already, and GDP has dropped materially already. On top of that, central banks at that point will be easing very aggressively because, hey, a lot of damage is being done. And as you say, every time you get into a recession, inflation slows down too. So at that point, there will be no reason left for the Federal Reserve not to cut rates. The labor market is much weaker. Unemployment rate is up. It's their second mandate, as you say. Inflation is slowing down. They will be easing and earnings negativity will be fully priced in. That is the moment where you need to say, now I want to buy a lot of good companies and own them for the next 5 years. When is that going to happen? I'm going to keep updating you guys. I mean, macro is always a puzzle. Stuff moves, new data comes in. My assessment as the set of information I have now is that this is going to happen perhaps in Q3 24, Q3 23, Q4 23. There is a long way to go. And in the meantime, we need to be patient.
1 year is not that long. This year flew by quickly for me, very quickly. I remember last November like it was yesterday. But we can keep track of things from your work by following the macro compass. Yes, you've expanded your service. Congratulations. Tell us about that.
Thanks, David. So until last year, I was running money for an institutional company, and I didn't feel right because I couldn't share actually my knowledge with people. It was like an ivory tower reserved space. I wanted to be able to share my knowledge and access to macro data, etc., with retail investors, which is what I did in 2021 through the free newsletter, The Macro Compass. I realized at some point that if you want really to step up the game for retail investors, a newsletter is a very good thing, but it's not enough, because people need to get more information more often. They need to get interactive macro tools where they can see the same things I see, analyze the same data, get access to this data, which is only reserved for institutional investors. They need to get trade ideas. They need to get courses. They need to get their hands dirty. All of that is not possible on a newsletter. So I stepped up the game and moved it to a platform, which is themacrocompass.com, is now the website, where you can see a lot of products being there on offer that are tailored exactly for what people need, and they encompass educational, interactive, and actionable products. The idea is to bring people through a journey, a macro learning journey, to become a more informed and a better macro investor and bridge this gap between us. I'm also on this side now, retail investors and professional, institutional, financial institutions that have access to expensive platform databases, macro knowledge that is reserved for them. I want to close that gap because I've been, lucky enough to be on that end. Now it's time I do a service and actually I close that gap for people too.
Okay, I want you to address this criticism. Before I worked as broadcaster at Kitco, I was actually a macroeconomics researcher. Not as smart as you, but I liked it. And there was a running joke at the firm: those who can't do, they teach. Right, so it's like a bunch of a lot of my managers were ex-Goldman fund managers, and they did very well. But now they're just writing newsletters for fun. And the common joke and criticism that we talked amongst each other is that if that guy was such a good trader at Goldman, what is he doing here? Right? Please address this. Right? If you're so good at managing money, Alfonso, why share it with the world? Why not just keep that knowledge to yourself?
So let me say this. Actually, my track record is public this year as well. It's been a pretty good year. I'm up 30% this year. 30% is not my usual performance. I wish it was that every year, but it's not. It's a bumpy road for everybody. But listen to this. I mean, it's the Macro Compass is not only talking the talk, but it's also walking the walk. So what I will do is share my ETF portfolio, share my tactical trade ideas, so people can assess by themselves whether my macro models are working for them, are not working. They're providing enough knowledge. The Macro Compass is also about an educational journey, because it's not about macro gurus the whole time. I want people to step up their own macro game, to learn how to use these tools, how to look at market. It's not only about following somebody because he's a guru, but it's about getting through this learning journey. People will be able to assess my portfolios, my tactical trade ideas. I'm an open book. I have nothing to hide. Very transparent when I'm wrong as well. So this will not change on the macrocompass.com.
Great. Well, all the best. Good luck to your new journey. I believe you launched this recently, correct? So
it's been launched actually, I think yesterday or a couple of days ago when the interview goes live. By the way, David, if I can add that, if people want to sign up, actually, if they use the code ALF, they get a 10% discount on all products, just to incentivize people to go and have a look at the macrocompass.com. And thanks again for having me here and giving me the chance to talk about the platform as well.
Okay, great. Well, I hope the cost of subscription doesn't go up with inflation. We'll keep that. I'm kidding. Please help us out. Okay. All right. Thank you very much for coming on the show. I appreciate your time, and we'll talk soon.
Thanks, David.
All right. And thank you for watching Kitco News. Please don't forget to subscribe and stay tuned for more. I'm David Lin.